Hey, how's it going? I hope you are well. I want to say thanks again for reaching out for some help. And, as I promised, there's going to be sort of this little video will kind of give you a good sense of how I would think about investing in your case. And by no means is financial advice, and I'm not like a CPA. This would probably give you a good head start in whichever direction you're choosing to go, right? Assuming that you want to make money in the markets. So, number one, my biggest hero is Warren Buffett. And Warren Buffett famously made a bet how to make money in the markets, and there's number two, how to avoid paying taxes. Okay, so we'll start off with number one, and there's actually a third, right? Which is how do you reach your goals? Right? What are your goals, and how do you reach them? Right. So for the first one, right, Warren Buffett famously made this bet with a bunch of hedge funds, right, and a bunch of hedge fund managers, who basically, if you don't know what hedge funds basically are the highest paid people on Wall Street for the most part, right? Geniuses like PhD level computer scientists, statisticians, mathematicians, physicists, right? These people are brilliant. They have the highest level technology. They went to Harvard, Yale, Princeton, Stanford. They are just, the epitome of privilege and wealth. And they get paid to manage your money in hedge funds, right? With computer algorithms and things along those lines. And so Warren Buffett bet this hedge fund manager, right? That over the course of 15 years, right, the S&P 500, right, which is just 500 American companies, like the biggest, best American companies that trade publicly, would outperform basically all the hedge funds, right? And by year 8, right, so they bet them over 15 years. By year 8, the S&P 500 outperformed so drastically that the hedge fund manager gave up, right? He just seceded, right? He was just like, Warren, you win, right? So he ended up giving like $1 million to like the charity of Warren Buffett's choice, right? So the lesson there is, right, you, me, right? The vast majority of us are not smarter or more well-equipped, well-positioned in any way, shape, or form to outperform the markets than a hedge fund manager is, right? Or any hedge fund is, right? We are simpletons. We are people who are not trying to overcomplicate things, right? That might be rough, right? But if you can admit that to yourself, then you position yourself to outperform. There's a statistic, right? Outperform 94% of market, right? 94% of like all investors, right? That's because 94% of investors cannot beat the S&P 500, right? So now with that being said, like, how do you invest in the S&P 500? What does that look like for your goals, right? So let's look up average return in the S&P 500. Let's look up over the last 20 years, right? So over the last 20 years, it returned about 10% a year. So let's take that 10% and go over to this little investment calculator. And I love playing with these numbers, right? Because they're just kind of like fun to see sort of, what happens. And I'll send you the link to this as well, right? So number one, all right, let's just say you want to retire with $1 million, right? I know you have your 401k with Bambi, right? Which is great. So definitely factor that into this, right? But for your own personal investments, right, outside of the 401k. So right now you said you're 39, right? Let's just say you want to retire when you're 60, right? If that's your goal, right? You could adjust these numbers when I send you this, but just for conversation's sake, I'll show you just like how I would think about it, right? So number one, let's say you want to be a millionaire, right, when you retire. So you have 21 years before you're 60. Crazy, right? Time flies. It's insane. So right now, let's say you start with $20,000, and then at the end of every month, you put in an extra $500, right? We're trying to figure out the return rate that you'll need to make $1 million. Now, we already know the S&P 500 returns 10%, right? So if this is 10%, like we can pretty much guarantee that you'll be a millionaire. Not virtually guarantee that you'll be a millionaire when you retire, right? But anyway, so let's calculate this. Looks like you'll need about 14% per year if you invest $20,000 right now and $500 at the end of every month for the next 21 years, right? So you'll invest $126,000 and you'll make $1 million if you achieve this. We know that it'll be very hard to achieve 14% for the next 21 years. It's not impossible, but it's improbable, right? Given, what history has shown us. So if you were to do $1,000 every month, right? This is why I say there's no correct answer, right? It depends on your goals, right? Maybe your target is different. Maybe you want to earn $10 million in retirement, right? At that point in time, you change this number. Now, Maybe you have less than 20,000. Maybe you have more than 20,000. At that point in time, you change this amount, right? Maybe you want to retire at 50, not 60, right? Maybe you want to retire at 70. At that point in time, change this number, right? But for this conversation, we'll go ahead and change this to $1,000. And now at this point in time, if you invest $1,000 at the end of every month, right? At this point in time, it's probable that you'll be a millionaire when you retire. There's another thing that I'd like to talk to people about, which is, so with this $1 million when you retire, a lot of people have a misconception around like what that actually means for you in retirement. A lot of people think like, I have $1 million, like when I turn 60, I have $1 million to live the rest of my life with. Like every single time I buy groceries or like pay my mortgage or, you know, whatever, right? It's hurting my $1 million, right? So if I spend $60 on groceries, at that point in time, I have $940 left over, right? That's actually not the case. So if you have $1 million in retirement, you still make this 10% per year, right? And so what is 10% per year? It's $100,000, right? So you can go sit on the couch or do whatever you want to do, right? Go on vacation, whatever you enjoy. And if you make 10% a year on $1 million, right, you will make $100,000 per year. That's another thing to think about, right? So it's not only your nest egg, right, that you're like leaving to your children or to your nephew or niece or whoever, right? It's not only this, but it also impacts the income that you actually have in retirement. $1 million is equivalent to $100,000 a year, right? If you achieve 10%. If this was $2 million, you'd make $200,000 in retirement, so forth and so on, right? And so long as you're achieving this 10%, okay? Next thing is, right, like let's just see, right? So we know that the S&P 500 was like 10.05%, right? So if you were to do the same thing, right, invest $20,000 now and have $1,000 every month, right? And I know you have like a boyfriend or a husband or fiance. I think the last time we spoke, it might have changed. But, you know, together, potentially, you guys might be able to do this, or yourself, right? Or whomever, right? But if you guys were able to do this here, at that point in time, you would basically have around $957,000, which is equivalent to $95,700 in income per year, right? That's really good, right? I mean, in California, it might be tough. At the same time, it depends on your expenses and whatnot, right? $95,700 a year is not a bad salary by any means, right? But not a bad income by any means. So that's sort of the first two pieces, right? The first piece was like, how do I make money in the market, right? With like low risk. Basically, my advice there is just to like listen to Warren Buffett and not try to be too smart about things, right? The software that I built, that's the first thing. How do you make money? Now, the second thing is like your goals, right? How do you achieve your goals? And it's simply by, you know, figuring out what you want to achieve, right? From a nest egg perspective, right? From like a savings perspective, and then also like an income perspective when you retire, right? And then figuring out what you need to do to hit that goal, right? So that's the second piece of it. Now, the third piece of it is like, you're going to get taxed, right? How do you avoid like paying the government everything, right? As best as possible. And again, by no means am I, you know, licensed in any of this stuff. I just read a bunch. Right? There's a couple of account types. Number one, so a Roth IRA is going to be, so tax-free withdrawals in retirement. The main point I'm trying to make here is you should probably stop using Robinhood, right? Whatever you do, you should probably switch to like TD Ameritrade or a brokerage that allows you to have more control over your account type. Because in Robinhood, I think it's just like a there's no tax benefits whatsoever, right? You really have no control. It's just like a normal brokerage account. It doesn't let you choose a Roth or a Roth IRA. So it doesn't let you choose an IRA or a Roth IRA, right? So the reason why you would choose this here, right? So basically, when you choose this, you get taxed on the $20,000, okay? When you take out the money in retirement, right? The $100,000 that you make, right, per year, you don't get taxed on the $100,000, right? It's tax-free. You've already been taxed on the $20,000. The reason you want to do that, right, is because you're making less money now, right, than you would be in retirement, right? So you're making more money in retirement than you are making right now, right? You want to reduce the taxes you're paying in retirement. Hopefully that makes sense. Now, if you're making more money right now, right, than you will be in retirement, right? Let's just say you're making $200,000 a year right now, right? But you're only going to make $100,000 a year in retirement, right? Then you would probably want to choose just a normal IRA, right? Which is basically the opposite of this, right? You would get taxed when you take money out, but it's tax-free when it goes in. that's the third piece of it, right? And again, it just depends on your goals and sort of what you assume, like some assumptions that are going to be that you need to make, right? But generally speaking, those are the three main points, right? Like how do you make money? How do you determine your goals, and how do you hit your goals? How do you avoid, paying any unnecessary expense? So hopefully that helps. And if any of these topics are if I've explained them too complexly, and you need me to simplify or explain anything, feel free to let me know, and I'll be happy to help out. Hope you enjoyed, and let me know if you have any questions. Peace.